essential solutions. If you need help with accounting and taxes or personal finances, contact me today at dakotagrady.com. Also, while you're there, there's a resource for you if you want to get tax strategies to save money in your business. Click on the taxes solutions page and you'll see a resource for you for tax strategies for your business. Again, the website again is dakotagrady.com. Y'all, we're gonna talk about the accountable plan today. Yesterday I talked about an S corporation and how important an accountable plan is. Today we're gonna dive a little deeper, talking about an accountable plan, what it is, and how you set one up. I used to have a client in Florida. I helped set up an accountable plan for her business. She's an S corporation, and I wanted to just give more insight because in my opinion, I don't think this is discussed enough when it comes to entrepreneurship. People may say start an S corp. Yes, you can start an S corp, but they don't tell you that you need to be an employee of the business. One, to get paid a reasonable compensation, and number two, to have an accountable plan. So let's talk about what that is. According to the IRS, this says basically under an accountable plan, allowances or reimbursements paid to employees for job-related expenses are excluded from wages and are not subject to withholding. An allowance or reimbursement policy, not necessarily a written plan, is considered an accountable plan if one, there is a business connection to the expenditure. Two, there is adequate accounting by the recipient within a reasonable period of time. And three, excess reimbursements or advances are returned within a reasonable period of time. This is according to the Internal Revenue Code section 62C and Treasury Regulation section 1.6-2C2. I know it's a lot, y'all, but that's what it is. So let's unpack that. If you are an employee of the business for your S corporation, you own it, but you also have to be an employee, right? When you have an expense, it must be business related. Now that means that an expense that's business related is something that is ordinary and necessary. So that means your expense must be ordinary for your industry. Other companies within your industry must do the same thing to basically get that expense, right? It has to be business related. And it must be necessary. So that means expense must be necessary for your business. So for example, if you have a plumbing business, right? Well, you need to have things that are used in your industry to do plumbing, right? You may need something that will unclog toilets, may need something to do with electrical work, so you fix on someone's HVAC, or other things related to your business. So it must be necessary and ordinary for your business in order for it to be a business expense. So again, it must be a connection with the business, which according to this document here, business connection means the employee must have paid or incurred allowable business expenses while working or performing services as an employee. Then reimbursement or advance must be payment for the expenses and must not be an amount that would have otherwise been paid to the employee as wages. And that's Treasury Regulation Section 1.62-2 D as in dog. So again, you must have some kind of business-related connection. The second one is it must have adequate accounting by the recipient within a reasonable period of time. So let me give an example of that. When I was an auditor for a company in South Carolina, I audited collection agencies. Well, when I audited my clients, I used my personal credit card for my travel, whether it was hotel, airfare, rental car, right? I paid for that personally. Then I would get my receipts, and when I would submit this receipt, I would also include an expense report tallying up all of my receipts that were business related, and then I would get reimbursed. This is essentially what this is. It's basically if you're an employee of your business as an S corp, you're going to have adequate accounting of your expenses. Again, the document says the employee must verify the date, time, place, amount, and business purpose of expenses. Receipts are required unless the reimbursement is made using per diem rates for only, and this is per diem rates are only available for certain expenses. So again, you have to have receipts to substantiate your business expense. Otherwise, you can't deduct it, all right? So if you were traveling on behalf of your your business, going to see prospective clients, for example, and you're paying for hotel, meals, travel. You may do an Uber or whatever you do to travel to get from your hotel or the airport to the hotel to your client and back. So those are expensible, but you must have receipts. Again, it says here, date, time, place, amount, and business purpose. Now, if it's a personal trip in addition to a business trip, so you have friends in the area, you have to basically say, all right, what percent of that trip is business and what percent of the trip is personal. A part of this business, you can again get reimbursed for that, but you must have adequate receipts. It then says a timely return of expenses, right? So timely return of expenses, the employee must return any excess reimbursement within a reasonable period of time. So there are, I think it's like a time frame, 30 days, I believe. Let me see if I can find it here for that reimbursement amount or time period. See here. I think it breaks it down, but I don't see it right away. But there's a period of time you have to actually reimburse that in order for it to not go a part of your income. So if you don't reimburse, say for 30 days, for example, or 60 days, then that money that you are reimbursed as in excess will be reported as income to you because, again, it's more than what you actually spent. So if they're going to reimburse you, the company's going to reimburse you for what you actually spent for business purposes. Anything above that will be income to you if you don't reimburse. That means give it back to them, the owner, the company, the employer. So let's pretend like you don't have any kind of plan in place. You aren't an employee of the business, but you are the S Corp owner. Real life story. Had a client who was in Florida. She owned an S corporation. She wasn't an employee of the business, but she had business expenses. So I told her, well, since you're not an employee of the business, you know you're an S Corp owner, and you don't have an income plan, anything that you spend for yourself through the business will be income to you. Why is that? Again, because she doesn't have an account plan in place. In order to get reimbursed, she must be an employee of the business, paying herself a reasonable salary. And again, she must be using her own personal debit or credit card. You can't use a business credit card, a debit card, because when the company reimburses you and you provide receipts for that reimbursement, you submit it in a timely manner, then the person, an employee, will reimburse you for those expenses. However, again, if you are an employee of the business, you can't say I'm an employee, I'm going to get reimbursed. You're the owner, so that reimbursement will be included as income to you because the whole point of the account plan is for you to get reimbursed for any expenses you spend on behalf of the business. You own the business, but you must be an employee of the business as well. So in order for you to get reimbursed for your business expenses that you spend on behalf of your business, you must, one, be an employee of the business, one, two, have an accountable plan in place, and then follow the steps again for an accountable plan, which include the three I mentioned earlier. It must be a business connection with the expenditure and have adequate accounting for the expenses, and then any excess must be reimbursed. That's simple. Now, if you want to find out more about this, go to the IRS website. You should be able to find out how to do any kind of a plan. They give you the same thing here, and just create a plan based on this, or have someone create it for you. Because I recommend having it in writing, even though it says here, not necessarily a written plan. I recommend putting it in writing because if it's not in writing, it doesn't happen. It hasn't happened. So make sure you have a plan, a written plan in place so that you can be professional. If someone wants to come audit your business about your accountable plan, you want to make sure to document that you have one set up. And then that way, it'll be official that you have an accountable plan and that you're following it. And if you need to refer to it, make sure you're doing it the correct way. I hope this is beneficial to you. I know that you may not have heard of an accountable plan. If not, you can find out more about this on the IRS website. Just type in accountable plan. It should give you information, or type in Google, whatever you search engine you're using. to find out more about an accounting plan, why this is important, because if you don't have one in place, you'll probably pay more in income tax because you basically have more income. Because anything that you are reimbursing yourself isn't reimbursable. It's going to be a part of income, and the business can't expense it as a business expense. I hope this was helpful for you. Learning about an accounting plan. If you have an S corporation, if you don't have one in place, contact me today at dakotagrady.com. It's a website. And this episode of the Coins, Cashflow, and Conversation Podcast is sponsored by Upstate Essential Solutions. Again, the website again is dakotagrady.com. Get resources there for personal finance and business finance as well. Bookkeeping, taxes, and advisory. There's also a resource for you there to find out how to save money in your business with tax strategies for you and your business. Again, this is the Coins, Cashflow, and Conversation Podcast.